What's up, traders? Welcome to this week's episode of the Weekly Watchlist, where I do a technical analysis and give you my thoughts on the tickers listed up above. We'll of course be checking in on the broad market. After that, we've got our core list of companies. And if you stick with me towards the end of the video today, I've got 5 additional trade ideas to share with you, so definitely stay tuned for that. As always, anything that we are associated with is linked down below in the description, and without further ado, let's jump right into the charts. So kicking things off on the SPY weekly time frame, talking about candle structure and location as we always do. For structure this week, we certainly have a hammer candle where the buyers stepped up at the lows and pushed prices to the upper third of the weekly range. Don't get me wrong though, it was not enough buying pressure to get to the open, never mind through the open for an expansion of range to the upside and a green hammer close here on the weekly time frame. Nonetheless, we will give the bulls the win here from the structural perspective, just noting the significance of the long lower wick. When we start talking about location though, this is where things start to get a bit more interesting because there are many layers of the onion that we're going to peel back in today's video, which lend themselves to the title that the quote-unquote crash may be coming for a pause, but isn't necessarily over. So let's get into those layers now. On a surface level, we clearly have a bar-to-bar lower high, significant lower high, and a bar-to-bar significant lower low. That obviously falls into bear category. If we go ahead and scrunch up the chart a little bit and remember that we are amidst a head and shoulders pattern, remember that our neckline is a moving target, all of the week's price action was acceptance underneath that neckline, which again falls into the bear category. It would have been a different story if we popped below and then got some acceptance back above, but you can see all of the action was underneath that neckline as drawn in there. Now, where things get interesting are, again, if we peel back the layers of the onion and pop on something like a weekly volume profile. If we zoom in here, it's the same weekly time frame chart, but we've got the volume profile on the left-hand side. There's the hammer candle that we were just discussing. Notice that we have a high volume node right here, and that's exactly the low of this week's worth of trading activity. We filled in the low volume node here. We traded through that rather with relative ease, and we found support at the high volume node. So if we do something like that, technically speaking, we have a hammer candle forming at support from the high volume node. And to add on top of that, if we come on over to TradingView and look at this yellow line, this is the anchored VWAP coming from the sickness lows of 2020. It's the same exact level. So for those two reasons, we have confluence of support. We have a hammer candle. I would be of the belief that we could see some sideways action here or even a little bit of a dead cat bounce. The other thing we can tie in, if we just flip back on over to Thinkorswim, I'm not much of a candle counter myself, but if we do just count them, so 1, 2, 3, 4, 5, 6 red weekly bars in a row here, I don't remember the last time the S&P did that. Even prior to the sickness crash in here, it's very rare that you see 6 bars, red bars, to the downside without any sort of buying reprieve. So for the multiple reasons I've just outlined, I do think that the quote-unquote crash could be on pause into the upcoming week, but not necessarily over. For it to be over, obviously we would have to make either a new higher high above this area in here or form some sort of higher low, and that would require multiple weeks worth of trading activity. So for those reasons, I think it's a pause, not necessarily over for good. Could it be the start of something? Yes, but we don't have that information quite yet. Let's drill down to a daily time frame now. We'll pop our levels on. We'll start talking about the nuances, the nitty-gritty, what you came here to hear. So there we go. We got that volume profile out of here. A couple of things I want to point out. You guys really seem to be responding well to the weekly expected move, which is this gray box right here. We would expect the week to be contained within this sort of range here, but nonetheless, the upper edge of the expected move is coinciding beautifully with 415.50, which, as we know, was the double bottom from in here where that really aggressive rally came from. But also, when we came round trip, we formed a dead cat bounce off of it, and then when we sold through it, obviously the more aggressive breakdown did come from that level as well. So 415.50 has significance from not only the weekly expected move, not only the double bottom and breakdown point from in here, but if we take out the Fibonacci's, I mean, there are so many layers to this week's sort of analysis in terms of thinking about all of the things that we have in terms of confluence. Look at that. From the high here to the low from Thursday, your 38.2 has perfectly married up with that level there around 415.50. So to me, if we see any follow through to the upside over the course of this upcoming week, I'm really really looking for it to sort of, I don't want to say stop here, but definitely run into, some struggles as we start to take that out to the upside, noting that the trend is clearly down, as we'll see in the sectors in just a moment here. I think there's strong possibilities that we form lower highs in the sectors and continue the downtrend. But again, overall, a little bit of a pause from just the straight shot lower that we've been seeing over the past couple of weeks here. The other thing that would not really have me overly confident in this being the overall bottom is the fact that on Thursday and Friday, as we did get this buying activity, volume was actually tapering off, right? So not as many people willing to participate and engage to the long side at these lows. Nonetheless, what are the levels that will unlock this breakout to the upside? Obviously, this is your breakout point around 405. You can see prior support, then flip to resistance for a 3-day balance range high. If we can take that out, that's where I think we get into that 415.50 upside target. If we can't and we just consolidate down in here, then again, maybe we're just building out some sort of a bear flag that would look something like this. We talked about that 415 being the 38.2 from this sort of perspective as well. So nonetheless, again, I do feel like we're still in the category of the bears being in control here, but just some scenarios to watch out for dead cat bounces, right? 405 leading to the 415.50 breakout. Anything to the downside that's underneath Friday's low, around 395.50, can bring us to the low end of the weekly expected move, and last week's low, that high volume node, the anchored VWAP low as well, around 385. I really don't think that the market wants to just blast right through that and get some more downside follow through. I really am of the belief that maybe we get some sideways activity here, if not even a little bit of upside lift. Again, 415.50 is that critical resistance. After that, though, we know that the trend doesn't really change until, again, we talked about this on the weekly time frame. We either put in a higher high, which would require taking this out up here, or we build out through time something that forms a higher low. I probably think if the market is going to turn here and see a significant bottom be put into place, it would happen via this, right? It would probably happen via a higher low, not taking out this for a higher high. Just my 2 cents on what may happen if we start to see some bottoming activity here. Let's get into our sectors, though, because I think we'll learn a little bit more about the marketplace and the structure there just by looking at them. Again, the XLY, consumer discretionary here, big chance for a lower high underneath the breakdown point from in here, which again, obviously falls into the bear category. So 162.15 is your critical watch. Can I get some follow through is the question, and do we form the lower high and then roll over for the equal low, keeping things in a downtrend? Obviously a bearish look here. Next up, we have the energy sector. This continues to just strike me as risk off, noting that we are getting price acceptance in this box up here. If it was going to come back down and be risk sort of on, and money could flow more freely into like your XLK, some of those heavier weighted sectors, then this would want to be at the low end of the range, if not breaking down slightly underneath. Obviously, we don't want an all-out collapse, but being that it's at these all-time highs essentially strikes me as a risk-off sort of sentiment there. The XLK, more similar to your S&P, obviously. Big chance for a lower high here, right? So can we backtest that 140 would be the question early on in the week. And if so, can we do something like this? That starts to become a little bit more attractive for a reversal. We'll have to only see when and if we can break 140, if that's a likely scenario. Based on the current look of the chart, again, we're just getting acceptance underneath this prior balance in here, which does strike me as a bearish look. Any lower high there obviously preserves the look of the downtrend, right? So this is why, again, I think it's really just a pause, potentially, not necessarily an all-out reversal to the upside. If it does start to turn into one, we'll take that in stride. But for now, we have to go with the prevailing winds, which, of course, are down. Next up, we have real estate. Again, this one does not look great, remembering that we wanted to see it fall out of this balance, but probably catch itself in here. Look at how much lower it ultimately went. We're sort of caught in bear flag consolidation down here. Even if it gives us a big dead cat bounce, clear chance for a lower high underneath 45, which strikes me as fairly concerning. XLC for communications, again, just another big concerning look here. Your back test point here was never really tested on this bounce. Even if we take out this sort of pressure cooker top here, I feel as though there's a high probability of finding a lower high underneath that 62 level. So we could do something like this and just continue on our merry way to the downside. Notice the big distance here between the 50 and 200 SMA, just going to reaffirm the significance of the downtrend that's in place. Any consolidation here strikes me as bearish. That can't take out that 59, and then we would look for follow through to the downside. Obviously, communications being a heavier weighted sector, not a good look for the S&P 500. Another cause for concern, Look at volume on Friday. I mean, this is just absolutely big red flag. As we come into that breakout point, no one's willing to transact there. I mean, look at how low volume was. So again, things are subject to change, but what we have in front of us certainly is not a good look for communications. XLB for materials, as we know, a fairly lightweight sector, playing nicely and bouncing off of this 80 support strikes me as a decent look. Again, we just want to avoid big breakdowns here, and as long as it's not leading the charge to the upside, that would be fine as well. XLP for consumer staples. This one did pull in off of its highs, so this is a better look for the S&P 500 finding a more meaningful bottom. As long as it stays nicely in this kind of range here, fantastic. And we covered this more in the midweek market update of last week. But again, this strikes me as a decent look. Not leading the charge to the upside, but also not breaking down aggressively. We are getting caught in this nasty area of like up, down, up, down, up, down, up, down. So if you're looking for a more directional move in consumer staples, I would probably wait to either get up and over 78 or break down underneath this sort of 75 area for a rotation to the bottom end here, closer to that 70 to 50-ish area that we discussed again on the Wednesday video from last week. Nonetheless, a decent look for the S&P 500, noting that this defensive sector is not leading the charge to the upside. Next up, we see the XLF financials. What's going on here? Still really nasty. To me, this is showing extreme relative weakness compared to every other sector that we've seen so far. Look at the Friday bar, just a little consolidation doji. Sure, we're bouncing off this 33, but we didn't make it anywhere close to the 3-day highs prior to that. There's a big distance to get to that. Volume, again, was significantly lower on the Friday session. Clear opportunity for some sort of lower high to form. Even if we do get a back test of like this 35 area, again, clear lower high can be in place there, which is why market crash is sort of on pause, not necessarily over as of right now. So XLF strikes me as being concerning. Next up, we have the XLI for industrials, really just hanging out in consolidation territory down here. Strikes me as not a great look for the S&P 500. We know it's a really lightweight sector, so I'm not overly concerned, but obviously any downward pressure is still downward pressure for the S&P in mass. Next up, we have the XLU for utilities. We know that this is a defensive sector, and the head and shoulders continues to just consolidate over here. We're building out that right shoulder. Multiple lower wicks on the failure of the bear flag breakdown. Apologies for that. Notice that we were really looking for it underneath like 70 quarter. A couple of lower wicks took that out, and we've rebounded back into the flag consolidation. Still strikes me as a decent look for the S&P 500. Remembering again that this is the defensive category here, falling out of this bull flag from up here. This look, because this didn't pan out to the upside, that has me feeling a little bit better about the S&P 500. As long as this wants to play nicely kind of in this area, it could even start to work its way higher again. As long as it's not leading the charge, I would say it's an okay look for the S&P 500. Overall, want to see this more sideways than aggressively trending higher, and it currently is obviously doing that by putting in this balance right here. Last but not least, we see healthcare. What's going on here? Make or break, right? Obviously, big weekly range, monthly range, really, where this 125 area kind of has been holding us up, right? So do we bounce here, and can we produce an equal high to the midpoint of the range is the question. If this really produces a lower high and then equal low reattempt, what do we have? Just a massive H pattern, right? We, of course, know that's bearish. Doesn't have to pan out to the downside. We obviously saw that right here with your H pattern that ultimately resulted in a rip. But nonetheless, the first implication of that would, of course, be bearish, especially given the overall market conditions. 125 must hold area here inside of the XLV as we go forward. And again, there's there's a lot of room here for a lower high to develop, which is the main cause for concern. So that's been our sectors from a structural perspective. Let's take a brief glance at our ratio grid. If we look at the big four, these are the risk on sectors, of course. None of them really look fantastic other than the XLV. And as we've pointed out in multiple videos, 1 of 4 is not enough to change sentiment here. Sure, the XLK is starting to perk up. Sure, the XLY is starting to perk up, but nonetheless still underneath downward sloping 50 SMAs here on the ratio grids. And the XLF really looking concerning. As we pointed out from the structural perspective, the chart doesn't look great on the candles, and even in the ratio, notice how we're going sideways. We're underneath a 50, downward sloping 50 SMA. Equal lows here, was not able to make a new higher high. The look would be for lower inside of this ratio, which again does not strike me as a risk on indication. So risk off still remains in play. And if we look at the risk off sectors themselves, notice how all of them look fantastic. The XLP continuing to scream to the upside. Same thing with energy as well as utilities. Again, 1 of 4 that's slightly deteriorated at the 50 SMA is not enough to change the risk off sentiment here. So from a ratio perspective, this all aligns with the fact that, Sure, we could see a little bit of a bounce here, a little bit of sideways activity, but overall, the underpinnings of the market certainly have not improved to a degree where we would expect a major bottom. Back on over to our regular charts, we want to take a quick peek at the VIX here. Of course, this is volatility. The only thing I want to point out about this chart is that we never broke out sort of up and over this for a big sort of capitulation, emotional, crazy sell-off bottom around that 40 handle in the VIX, and instead we're actually starting to form a bit of a double top. Now, traditionally, we don't look at volatility through the lens of, normal technical analysis, but nonetheless, if we can take out the quote-unquote neckline of this double top, anything underneath 26, that's where I would start to reconsider and say, okay, volatility is really subsiding to the degree where there's possibility that people are more comfortable to get back into the marketplace. But if we just consolidate in this overall range and we just do something like this with volatility, again, that to me is the look where I would say, you know what? The market sort of quote unquote crash, again, I use that word in quotes, is not necessarily over, right? Volatility is still very, very elevated over that 2050 floor. So those are my thoughts inside of the VIX. The next thing I want to point out from the S&P perspective are on the internal screen, and it really has to do with correlation. We've been discussing this over the past couple of days in the S&P, where we've seen really, really nasty degrees of correlation, both up and down, like wall-to-wall movements. We've discussed this in the Discord chat. We've talked about it in the weekly watch list, the midweek market update, all of that stuff. Whenever you see things like this, so all the way negatively correlated underneath 2,000, opening above 2,000, making the wall-to-wall move to negative 1,500. Again, same thing happens the following day. That's where volatility is going to eat you alive. Again, on Friday, my concern is that everything was correlated to the upside. So here's a couple of things you can carry forward into this upcoming early part of the trading week. So on Monday, if we get a neutral read in the advanced decliner, say it's not really in this trend zone up here and not really in the trend zone down there, where are we? If we're more neutral and the S&P is digesting inside, so we have an inside day, that to me strikes me as confirmation that this bullish activity will hold. If we see a neutral advanced decliner, but we're breaking down in the S&P 500, this is purely a dead cat bounce, right? This is short covering. So to me, that's how I'm reading these internals in the current market conditions. And again, seeing a massively correlated move on Friday has me slightly concerned. So I'm really going to be paying attention to this on the Monday and Tuesday session. Can we cool off in the advanced decliners? And what is the S&P 500 itself doing to either confirm or deny this bullish activity we saw on the Friday session? All right, so that's the main takeaway from this screen right here. Moving back on over to our other charts, I also wanted to bring this one up. We talked about this in a prior video as well. Remember that this is the percentage of stocks trading above their 200 SMA. And we've been talking about this yellow box. In the past week's worth of trade, we just barely dipped a toe into that yellow box. Notice a couple of instances do produce lows by just dipping a toe hardly into the box here and here as well. I suppose you could classify this one, but notice there are other instances where we literally have to make the move all the way to the bottom end, or at least, much deeper into the box here. So are we in the territory where a bottom can start to be in place just based on, so many things being sold off? Yes, but there's also some more room to go until we find, a bottom that would look more similar to one of these more aggressive instances. So I wanted to keep you updated on this because I did bring it up last week, and we finally are in the yellow box. The question is, are we just going to see a surface level tick here like we saw there and there, or will it be a little bit more aggressive? Something to continue to monitor here in our S&P 500 for overall bottoms, along with everything else that we've seen and discussed so far in today's video. So that has been an extremely in-depth look at our S&P 500. Let's continue along and get into the QQQ, the NASDAQ 100, of course. What's going on in this one? We'll keep it brief in the remaining two big broad market indexes. In the QQQ, here's your expected move. It's also tying in with 315.50. Very funny how the SPY and the QQQ are off by about $100, but nonetheless, top end of the expected move is aligned perfectly with our secondary resistance trend line. It's also the breakdown point from here. Also, again, make pretend and extend left. You get support and support as well. So to me, that level does carry a significant amount of importance into this upcoming week on any dead cat bounces. This general area is where you're going to look for the steam to sort of run out for the bulls. If we take out our Fibonacci's from the high all the way down to the low to be congruent. Notice how the 38.2 is slightly overhead. Nonetheless, again, this general area of the chart is really where I would say if we get a dead cat bounce, I wouldn't start pushing or pressing the bet long here, noting that we're coming into a lot of overhead resistance. Okay, so overall, I would say 315.50, 318.50, maybe even slightly underneath that in here, 313.50. This general area, give it about I don't know, $3 to $5 worth of wiggle room is where we should start to see significant resistance. Now, obviously, if we just blow right through that, something bigger might be happening in the marketplace, and we'd have to reevaluate that when and if it happens. But as of right now, we're looking for resistance and a lower high to be produced at and around these levels. If we don't get any sort of movement to the top end of this range and we just consolidate in here, you're obviously looking for downside in your QQQ. A big flush point is here around 297.50. I can show you that on a 30-minute time frame if we can find that. There we go. Notice how it was the higher low pullback from the Friday session. So again, giving that up probably disappoints a lot of longs who are expecting some follow through into this upcoming week. They probably fold, and that's where we get that follow through to the downside to the lower end of the expected move closer to 287.50. And then we do have an unfilled gap between 280.50 and 276.83 to the downside in our QQQ as well. Again, main look, let's see if we can get some follow through, a little bit of a dead cat bounce, but sort of top out around that resistance trend line. Last but not least, we've got IWM Russell 2000 and the small caps. What's going on in small cap land? You can see our weekly expected move comes right to the bottom of this prior bear flag. If we get follow through, that level is 184.50 for critical resistance. To the downside, if we just remain in this area here, if we can never take out 180.75, it's really just building out a nasty bear flag like this, and we would look for lower, right? So anything underneath the Friday low at 174.77 brings you to the bottom end of the range here, 169 roughly, and then after that we have 164.20 on IWM. If you're using this as a sentiment gauge like I usually do, then your main takeaway on this is ultimately here was obviously the range from in the past. There was the minor range that we built out early in 2022. We're still just getting all price acceptance underneath, which strikes me as a big risk off sentiment for the overall marketplace. So to me, this is another one of those indications that would say the market crash might be on pause, but isn't necessarily over until this can at least improve to get into the earlier range of 2022. So that's been the broad market. Let's get into these companies. If you've made it to this point in the video, I'm sure you're enjoying the analysis. Hit the thumbs up button and subscribe to the channel so you know every single time a new video comes out. And with that, let's get right into Apple here. You can certainly see that we are starting to get a little bit of that bounce off the bottom, but nonetheless, your critical must-watch level in Apple is going to be 152. You can see it was prior resistance in here. As I drag the cursor, we're getting some support there, support here, before ultimately the nasty breakdown, which occurred on Wednesday for the follow-through move to the downside. Nonetheless, 152, that's the must-watch number inside of Apple for the upcoming week. Based on the idea that the rest of the broad market may want to see a bit of a dead cat bounce, Apple should follow suit. And again, 152 will be right there for us to determine whether or not we're just going to form a clear lower high, do something like this, preserve the daily downtrend, or do we start to get some acceptance above with a higher low? Maybe the trend line starts to become an attractive target for the next move. So my first thought would be a little bit of follow through to 152. If it doesn't happen and we just consolidate in here, you're looking for breakdowns underneath 144 to get us into 139. Ultimately, that could look like a short-term H pattern like this, and breakdowns of 139, although I wouldn't chase this short here, breakdowns of 139, maybe after some consolidation, after a bear flag sort of gets built out like this, bring us into 135 here inside of Apple. Next up, we have Netflix. What's going on in the Flix? If we take a look at this chart, obviously it's a very ugly chart, but nonetheless, this is actually relatively strong to the market. If you think about what this would look like as a weekly bar, it's a green hammer candle. Notice that the Friday close is above the entirety of the 4-day balance that was put in before that. So to me, there's the possibility that two groups of people here get quote unquote squeezed. Now by squeezed, I don't mean that this goes to 500. By squeezed, I just mean that there's added buying pressure here. Anyone who is shorting in this range, expecting this to just build out as another bear flag and then breakdown, is obviously feeling some pain. And anyone who's still holding shorts from this bear flag breakdown, if they entered on the break of these lows, as we start to take out 190, those people start to feel some pain. So if we can clear 190, two groups of people should be closing out of shorts, and that's where I think we can see some added buying pressure to get to the back test of the original flush point around 210.75. That would be my bullish look into the earlier part of the week here inside of Netflix. To the downside, if we can't do that, if we just roll over and fall back into the 4-day balance, balance, what do we have that's a look above and fail? We should be targeting the bottom end of the range here at 165. And do we have anything mapped out underneath? 130. Wow, that must be coming from a weekly level or something like that. That's going to be a nasty move to the downside if we ultimately see the look above and fail, and then get some more follow through to the downside. Nonetheless, first and primary thought here inside of Netflix is, can we squeeze out some of these shorts, correct some of that inventory, and get into that 210.75 from there? So just thinking ahead, again, remembering that the market's kind of like a game of chess. If we do something like this, higher low pullback, maybe this builds out as an inverted head and shoulders. Just a thought. Obviously, there's a lot of work that has to be done before that's really in play, but something to be thinking about. Next up, we have Tesla. What's going on with Elon Musk and his Twitter deal? Obviously, he put it on ice with the idea that, quote unquote, he's not sure that, he's confident with the number of fake accounts that exist on Twitter. Nonetheless, I'm sure he's a smart enough man. I'm sure he knew exactly how many fake accounts were on Twitter before he initiated the deal. He probably just wants a better price. Whatever, that's besides the point. Inside of Tesla stock itself, certainly this would result as a weekly hammer, this price action right here. But notice on the Friday session, really, really indecisive and not able to get into the Monday and Tuesday range here, resisting at that 780.75. So first thought would be, if we can break above, you're probably looking for 823. And again, let me show you that on a 30-minute time frame. It's not technically the 2-day highs. It's that 823 coming from support, which was then resistance, resistance, resistance here as well. That would be my first target. So break of this high, boom, there's your day trade right there. Anything after that, you're watching for the flush point here at 861, back to the daily here. And then from there, really choppy in here, right? Really, really choppy in this section of the chart. So I would be careful there, but one step at a time, obviously. If this rolls over and we take out the Friday low, I probably wouldn't look to initiate shorts until we start clearing underneath 700, just based on, I don't want to call it extended because we've had some days of overlap here, but it does feel like, this 100% retracement should result with something that does this, either a little bit more sideways through time or a little bit of upward lift for a dead cat bounce, clear lower high. So again, probably wouldn't chase it short here, but nonetheless, if we do produce the lower high and come in for the equal low in short proximity of time, that's where the better short is produced, right? So that's Tesla in a nutshell. Next up is AMD. Certainly the possibility here for a double bottom to be in play, with your neckline being 100, the nice psychological number. If it breaks, your target overhead is 106, and the daily resistance trend line, remembering that that's coming from the all-time high. That is a very, very, very significant trend line. So that would be my primary target to the upside. Also remember, oops, we don't want to right click. We want to do this, zoom in. Also remember that this is just a weekly range, right? If we do something like that, you can see we're just playing ping pong in here. So 100 could be lucrative as well for shorts. Honestly, if the market bounces and starts to roll over, then AMD might do something like this. Maybe we get a green bar, and then here we print an inverted hammer. We're at the top end of the range, and we roll back over, right? So you could use tight risk. Stop goes over the high, entry here, target the bottom end of the range. That would certainly make sense from a risk-reward perspective if that's kind of the structure that you set up here. So overall, the pattern is a double bottom. If we take out 100 with some conviction to the upside, we're looking for that reversal here. But if we never get it, if we print the inverted hammer here at the top of the range, there's certainly possibility that it rolls back over and remains range bound in this area here, which ultimately speaking, from the weekly perspective, would be building out a bear flag, correct? So from there, 85 turns into a flush point, but early on in the week, I would be looking for that upside move. Next up, we've got Facebook. What's going on in Facebook? Sort of in a nasty spot right now. I think the better long is up and over this area here, 202.15. We talked about that on the pre-market live stream on Friday. So if we can break that, 210 is your target. And of course, anything that does this high or low above starts to become a little bit more convincing for longs. The reason we're thinking long in the first place is obviously we got into the gap right on the Wednesday session, a little bit of follow through on the Thursday, but after that, it was right back out of it. So why were the sellers not able to fill that gap in total when there was virtually no structure there? Strikes me as weakness from the sellers. So that's why we're thinking about upside first, but again, still requires a level break here at 202.15. From there, we've got the upside targets mapped out. Anything that just chops around in here is exactly that, really choppy, kind of a balance area building out. The better short is just trading for the remainder of the gap fill, and then from there, looking for that 169 low on earnings. Do I think that's the likely scenario early on in the week? Not really, as we've just discussed. Next up, we see NVIDIA. What's going on in NVIDIA? Excuse all the lightsaber lines down at the bottom, just some unfilled gaps that I was marking in from earlier on that I wanted to be aware of. I can read them out to you in just a second here, but nonetheless, before we do that, notice that we have a look below and fail back into the range. Target should technically be the top end around 185 quarter. That would be my primary objective early on in the week. And then from there, do we form a lower high at the trend line for the rollover? That's my sort of thinking here inside of NVIDIA early on in the week. After that, if we do breach these lows, the target will be the gap fills underneath. Let Let me read those out to you right now so you can put them on your chart. You could probably find them yourself, but maybe this will save you some time. 148.71 down to 146.81, and then after that, 142.80 down to 140.83, with 139 coming from weekly support underneath that as well. So overall, these would just act as downside targets. You're not actually going to trade for this dollar or so worth of gap range, right? So thoughts in NVIDIA, probably higher first on the look below and fail, come into this target, and then reevaluate to see if we start rolling over for a lower high, or if we start producing higher lows for a trend reversal. Just like what we talked about in Netflix, you can see how if we do something like that, there's your inverted head and shoulders. One step at a time, though, watching this 185 quarter like a hawk. Next up, we've got Microsoft. What's going on in Softy? Not as aggressive as a dead cat bounce. This weekly bar would certainly look a lot weaker than a majority of other things that we've seen so far. Notice that we're just coming in for the back test of this resistance now at 261. We'll ultimately have to see how this resolves early on in the week. If we do something like this, technically we did have a 3-day balance, kind of this area here. That strikes me as a look below and fail. It's not the cleanest one, noting that it's happened over multiple days now, and we even tried to get into it on Friday with very, very little acceptance and really thin volume as well. So to me, I would be a little bit more skeptical of this, but the major level, like if you wanted to compare this to Apple's 152, that would be this right here in Microsoft around 271, right? If there is any sort of dead cat bounce, this is probably the next area where you want to be on the lookout for shorts coming into the backtest of this really significant prior support, which was a breakdown point. You can already see it offered resistance 3 times in a row on the Monday, Tuesday, and Wednesday sessions of this prior week. After that, rollovers, you're just retargeting these same areas to the downside. If it doesn't make it there in the first place, you'll notice that a breakdown of Thursday's low opens the door into 239. Again, wouldn't be my primary objective to start shorting this after it's already seen some follow through from this area of balance right here. If you think about balance rules, technically we're always looking to double that range. Notice how we have doubled the range. Again, I wouldn't really be pressing the bet here until we get a clear lower high or some consolidation sideways through time. Last but not least, the beast, we've got Amazon, and then we'll get into those trade ideas quickly. I know today's a long one. Worth doing, though. You guys do seem to appreciate the longer videos. Nonetheless, Amazon, big breakout point here at 22.55. If it gets taken out, you're looking for a retest of this breakdown point at 23.90, and from there, the 2-bar highs at 25.20. This, to me, is really a level that you want to carry forward for, stronger longs. If we can take that out, I think a majority of people that tried shorting this after the damage from the gap down in earnings start to feel some pain, obviously, right? Anyone who's certainly shorting down here, as we move away from that, is going to be feeling pain. But really, those 2-day highs to me mark the level where, a majority of those people, everyone basically, after the earnings gap down, is, in the whole short, right? So that's the upside level. To the downside, anything that can't clear this, like again, if we never get over that 22.55, we're technically just building out bear flag consolidation, nasty bear flag consolidation, right? Something that would look like this, and downside underneath 2030, that opens up a whole can of worms, because as we know, that was really, we want the weekly chart, and we want to grab a couple more years here. As we know, that's like a really, really significant level here, right? So there's your big weekly breakout. We came in for the test, printed a hammer off of it. I do think we're in store for a bit of a dead cat. Again, I'm not much of a candle counter, but just noting that we have 1, 2, 3, 4, 5 candles red with a hammer candle last week. So technically 6, if you want to count that downward action. Maybe there's a little bit of a reprieve here back up towards the earnings gap down level. Underneath it, though, let's just say we had to pick out a level. I would start eyeballing the 1725, 1730 level inside of Amazon. And that's really going to wrap it up for our core list of companies. Let's get into these trade ideas. Quick reminder to hit the thumbs up button, the subscribe button, the bell button, all those buttons YouTube tells us to tell you about. And let's get right into these trade ideas with SBUX. You can clearly see we are in a nice, nasty downtrend here, getting a little bit of lift into the end of last week. The question is, when and if we come into the resistance trend line, will we print an inverted hammer? So this setup does require a little bit of patience here, and patience not only in the sense, can we get some continuation first, but do we form the right sorts of patterns around that resistance trend line, around that descending 50 SMA? Do we form a lower high underneath that 82-ish area from this high right here? So looking for shorts inside of SBUX. Now, you might be saying, well, you're looking for upside first. Why not just go long? Obviously, the prevailing winds here in SBUX are clearly to the downside, and I'm not really trying to make, a couple of pennies before I can make, what would that be, a couple of bucks, right? So in SBUX, primarily looking for resistance at the backtest of the trend line, and as we know through the broad market, we are expecting a little bit of lift early on in the week. Next up, we get Airbnb. What's going on in Airbnb? Breakout point here and thin structure from the breakdown in the past. So if the market does produce a little bit of upside lift, we're looking for this to break out inside of Airbnb. That's up and over 123.38. 128 for a move into 133 roughly from all of this historic support. It was a big breakdown point. So do we get a break and retest? That is the question. If you're skeptical, about going long Airbnb, fine. Just wait for a short potentially on the break and retest at that 133. From there, you're just looking for rollover into the equal low at 112 if you want to remain, really short biased here inside of Airbnb. Look at the moving averages completely sideways here. For that reason, I'm really more open to taking this long as opposed to something like Starbucks, which we just saw is clearly in a much nastier downtrend. Here we go with Snowflake, sort of the same idea. Can we come in for a break and retest at this level right here? 167.44 is the number. Clear downtrend. Look at the moving averages. Downtrend resistance trendline could also be a target if you're skeptical of the break and retest here. If you think it's going to go a little bit higher, you could also look for short opportunities at the trendline, which is closer to roughly 180. And nonetheless, if we do get there and roll back over, you're looking for the equal low. What's that number? That's going to be roughly around 130.64. That's a new all-time low here inside of Snowflake. Next up, we have AA for Alcoa, the aluminum company, looking for a breakout. This is more similar to that Airbnb. If we get a move up and over that 200 SMA, up and over these highs of the week, essentially thin structure on the breakdown, looking for the backtest of 64.19 coming from right around in here. If it doesn't happen, if we just go sideways, obviously over time, that does confirm sort of a bear flag consolidation look, and then maybe it's a breakdown. But currently, early on in the week, I am looking for the breakout here to retest that level. Again, 64 is your number. The trigger is going to be up and over 59 inside of AA. Last but not least, there's the saying, is going to be ANTM for Anthem. And you can clearly see a longer term support trendline, which has been struck in here. Notice that we have the higher high from the last interaction with the trendline. So we're pulling back off of a higher high, multiple hammer candles printing on the Thursday and Friday session. Do we take out this level right here? Let's go ahead and map that in together. If we can clear, what is that? 488, call it 490 inside of Anthem. A little bit of lift into this area right here would be my next target. Maybe 500. Like, let's not get crazy here. Obviously, the market's in a downtrend. This is clearly in an uptrend, so relative strength from that perspective. Look for 500 first, and then after that, 515, 516 could be the next upside target here inside of Anthem. Obviously, stop is going to want to go right underneath the support trend line, or if we print another hammer candle underneath that hammer low, something of the sorts there. So that's going to wrap up the video. If you enjoyed it this week or learned anything new, let me know down below in the comments section or by giving the video a thumbs up. Don't forget that our live streams will resume on Monday. We're going to have to pause on Tuesday and Wednesday. I've got some family stuff going on, but nonetheless should be back onto a schedule after that. Again, appreciate you tuning in, and I wish you all a green trading week.